Okay, so a little context. I actually worked in a nuclear facility.
Even better.
Yeah. I even actually once accidentally set off the alarms in a nuclear facility and got the whole place vacated.
Oh, that would be the most terrifying thing.
I did not admit it was me. I pretended it wasn't me. I said, why are we being evacuated? What's going on? And I knew exactly that it was me, and I was always too embarrassed to ever tell anyone.
Oh my God. Well, welcome to the hot take for the show.
There you go.
Welcome back, everyone, to another episode of VC Unfiltered. Super excited to have you here. Gabby from Dangerous Ventures is joining us on the show today to talk everything climate tech and about the new fund that she is starting out of New Mexico. Gabby, welcome to the show.
Pleased to be here. Nice to see you.
Great to see you again. I know that we spent some time up in Ojai not that long ago. Great little fun retreat. And I know we talked a little bit about it there, but for all the viewers and everyone else tuning in to watch, I want to find out a little bit more about the fund thesis, what you guys are up to, and then be able to take it from there.
Great. Well, I'm a GP at Dangerous Ventures, and it's an early stage fund based on climate resilience. So we back companies that are building a more resilient future for people and planet. And then mostly we focus our investment on technologies that help us adapt to the worst effects of climate change. Pre-seed and seed, we're not leader investors, we're follow investors, and we write checks in the 100,000 to 200,000 range.
I have a little bit of a bone to pick with climate, so honestly, it would be great to have a discussion with you about it. So I've been a big proponent of making sure that, of trying to find tech to invest in from a climate perspective for literally the last 20 years, right? So it's something that I've consistently looked at. I feel like it can be very difficult to find great climate deals, and I wanted to just get your kind of take on what you're seeing in the market right now. Has things become overpriced, or are the founders doing that right balancing act between being able to still make money for LPs and save the planet kind of at the same time? Because I feel like sometimes there's this tug on both sides that some are very focused on one and not the other.
Okay, there's a lot in there. So let's go back a second. So first of all, your point about looking for it for 20 years. So anecdotally, I was a nerdy scientist at college, and I actually built an electric car when I was 16, and I was a scientist at Cambridge, and then I went and was a nuclear power and land contamination lawyer, and I invested in a friend's company that had wind farms, and I proverbially lost my shirt because 25 years ago in the UK, people were not ready for wind farms. They didn't want things in their backyard, and so even though they had all the connection agreements in place, all the leases, they could not get planning permission. And it turned out we had to sell the portfolio to a utility because they have a bunch of lawyers on staff and they can wait 15 years for people to, change their attitudes. And my sort of anecdote is that 30 years later, every single one of the 13 locations that we had up, ready to go are now wind farms. But I lost my investment. So I was like, okay, climate, we're not ready for it yet. It's too big a task, requires government funding and all that sort of stuff to get it off the ground. So fast forward to today, and I think there's another really important point, which is that climate is a huge category. And in the same way that when the internet came along and then mobile came along, there was a whole sort of role for people to be a digital strategist whilst people figured out what their digital strategy was. Eventually that role goes away because everything's digital. And I feel quite strongly that we're in that phase where everything eventually will be climate. And so in that respect, there's enough opportunity for any company that wants to do exactly what we're doing today differently in the future with a climate lens to do it in a more sustainable fashion. That means that there's room for software-only startups all the way through to massive infrastructure projects. And therefore, you have to be sort of specific about what you mean by, climate investing, climate founder, right? And as a result, it depends where you want to play. Obviously, the J curve on climate is, bigger, steeper, and longer than it is on software or consumer tech. But the sort of first of a kind approach means you have massive opportunities. And if you get it right, you can have huge businesses. But I also think that you can have a bunch of businesses which are not decacorns and massive, but they are doing something really meaningful in the climate space by simply doing an existing process or technology better and more efficiently, reducing carbon and doing it, and making the outcome for the customer more financially rewarding. So I think there's a lot of opportunity to play in all different scales and sizes of the climate stack. And as a result, you're going to have some funds or some companies that are going to do really well, and some that are going to be too long and too difficult to get off the ground because you need a critical mass of adopters who are not going to do it quickly enough. And I don't think that's any different from any other type of deep tech. So I guess one of the points I'm saying is that for me, climate requires you to move atoms around the world differently. And so software-only climate funds or software-only climate companies are going to find an easier time of getting their business off the ground, but they may not be making the impact and the difference that the deep tech atom-moving companies will make.
Have you seen a lot of 100% climate-focused software companies that are just looking for inefficiencies? Because
every carbon management or carbon credit platform is essentially software open, right?
Yeah, I guess that's true, but it's creating a new market. The carbon credit, the cap and trade stuff. I mean, it hasn't taken off as much as it probably should have from what I've seen. I'm trying to think back to this stuff, and especially in Europe where they were implementing a lot of it. And it didn't seem like it kind of fell with the wayside with all the ESG stuff.
I'm not an expert on carbon credit markets, and we don't invest in them for lots of reasons. But just to quickly move past that point, I feel like as many arenas, there's a lot of experimentation to try and figure out what works and what's going to get adopted. It's no different from, Betamax versus VHS or whatever other thing you want to compare it to. And there's going to be a market for carbon credits, and it's going to be a way of doing it that's efficient and integrity filled and it works. And so far there's been some lack in those areas. And I think that means they're just going to keep iterating until they get it right.
Yeah, no, I would agree with that. I mean, especially when we're looking at the landscape, there are going to be a lot of, that's what we do. That is venture, right? Right. 90% of our stuff is going to fail.
Exactly. Trial and error.
Yeah. So I wanted to jump back to the point where kind of this push and pull from a founder perspective, and still, let me give an example. I had someone that I remember looking at, and this was, I don't know, probably 4 or 5 years ago, and great founder, really liked the business. They were redoing reefs in coastal, I think in Latin America. They were rebuilding the reefs basically so that when hurricanes came through, that they were not going to be as impacted by the changes in the weather patterns that we're going to end up having because of climate change.
Right.
But when I was talking with the founder, like the idea didn't seem like it was like, hey, we need to go up and to the right in the typical kind of venture deal. It's like, hey, most of the people that are investing into us realize that it's not necessarily just about the potential return, that it's also about the impact that it can have from a climate perspective. And so is it difficult to see with the founders, or are the LPs that you end up having okay with that type of mentality because of the actual impact that you're going to end up having from an investment standpoint in general?
The word impact is the key point here, right? So there's people who say they run impact funds and their primary measure is impact, whatever it might be on society, the planet, etc. And then you've got a whole bunch of LPs that hear the word impact and they immediately assume it's going to be concessionary capital and they're not going to get a venture scale return. So we thought very carefully when we started the fund whether we would call ourselves an impact fund. And we do not call ourselves an impact fund for exactly that reason. We don't want LPs to think that we're in any way concessionary. However, we do expect there to be significant impact on the planet from the companies that we back. And all of our founders measure impacts of day in, day out. It's their bread and butter. It's how they measure their own success. It's just that we don't ask them to report in some compliance way with a massive report on impact every year, because I think that's pretty onerous on young founders who are just getting going. Having to spend all their time reporting to boards and impact investors is really hard. And so I'd rather see the impact in reality. So I'd rather substance over form. And in that respect, you're going to have a different type of LP. You're going to have the LP who says, I believe that the climate space is so full of opportunity that I'm going to make money no matter what. Larry Fink, I think he walked it back, but Larry Fink from BlackRock did say the next 1,000 unicorns are going to be climate companies because they have to be. So you could argue on one end of the spectrum that there's no concessionary capital at all. The impact is a wonderful side effect of actually doing well whilst doing good. And then there's going to be other people who say, I understand that this company is never going to be a decacorn. It's probably not going to be a fund returner. And we'll come back to the power law in a second because I have a lot of theories about the power law. But it's not going to be massive, but it's going to do a really great job of what it's set out to do. And it's going to be a perfectly sustainable, great business in the $300-400 million range and have a good exit and will have a massive impact. And I think, people are on a spectrum in between the two. And if you get a really great LP, they want both.
Yeah, I mean, I'd love to have both. Sometimes you end up having to choose, and it becomes, it becomes challenging from that viewpoint because we're stewards of capital, right? We're beholden to what the LPs want, and I don't think a lot of founders really understand that. They're like, oh, they're VCs, they have money. It's like, no, we are the middlemen in between both. Like that's literally it. Yeah. So walk me through. So power law, you said you have a lot of, and we've been talking a little bit about mid-market stuff. So I want to, let's dive into it because I want to hear.
Okay. So maybe people will call me naive and, we're emerging managers and we have a long time to prove ourselves out. But I do actually believe that power law just may not necessarily have to be the only model that works in climate. So I think about the power law as being associated with a sort of, B2B SaaS or consumer tech environment where it's very much winner takes all. And you'll take, Uber and Lyft. They spend billions of dollars on marketing in order to be the dominant player in a market and crush the competition. And all that wasted money and effort on trying to be the sole winner. Whereas, climate is a scenario in which you need a little bit of everything everywhere all at once. And a solution that works in Florida may not work in Texas. And every state has a different natural resource base, a different sunlight, land, wind, rain, whatever it might be. And so whatever you're doing in each place, geographically, located, may be a big business, but it's not going to be a nationally big business. So in other words, it may not be a decacorn business. It may be a, as I say, mid-market business. But if you have a lower failure rate, because, of course, the power law is predicated on the idea that 80% of companies fail, and then one of them is your fund returner, and it's a decacorn. If you have a lower failure rate, you model it out, you actually get a much more consistent set of returns, and you can do just as well, if not better, than a model and a portfolio construction that expects to get, one massive fund returner and then some, or one, decacorn that's sort of your knock it out of the park result. And I think that's just because there's a fundamental difference between the kinds of businesses in, say, B2B SaaS, consumer, and climate.
I guess the first point is we're in the Wild West, right? So that's what the startup land is. There are no set rules to me right. in general on how this plays out. Because it all comes down like how do you shift the failure rate? If you can do that, then it's a different story. But the challenge, again, this also has to do with fund construction, right? Because if you have a fund that is sub 100 million AUM and like you can have mid-market exits that 3 to 4x the fund and you're still going to do in totality, right? Not in just in general. But you can still do extremely, extremely well for the LPs and have mid-market exits and not need the actual unicorn. If you have $1 billion fund, I think it becomes significantly challenging. I have challenges with multi-billion-dollar funds anyways from in a venture standpoint, just because I don't know how the threshold that you end up hitting on the number of good startups in general, I think is their upper limits to that.
Yeah, the math just doesn't work for them. And also you have to stuff so much money in in order to have the ownership, in order to get that return, which is of course why the data shows that smaller first-time funds, emerging managers often get really good alpha and get really good returns because, it's mathematics. It's really simple. We're investing in what I call picks and shovels, right? The building blocks, the pretty prosaic industrial kind of things. And frankly, in another era, they might have been, businesses that weren't venture backed. And in fact, that's another point. Not every company should be venture backed. And we know that in climate, you need a lot of alternate sources of funding, whether it's from all the government bodies that give you, the SBIRs, et cetera, or, public-private partnerships, even philanthropy to get scientific experiments off the ground. So in that respect, there's less chance of growing hockey stick fast, but there's more chance of being sustainably successful at doing a job, doing it well, and doing it profitably. And I think the last few years have also shown us that, the grow at all costs mentality, fill everything up as quickly as you can, play with the greater fool theory of venture, which is all I care about is can I get a higher valuation from the next investor in line, until eventually you have, the retail investors being the chumps at the end who sort of take it on a poor IPO, right? I mean, that's the greater fool theory, isn't it?
Yeah.
So
It
if you take the greater fool theory out of the equation and you say, what is the goal of a truly successful, sustainable startup in the climate space? It's to actually really move the needle on adaptation, do it well, do it consistently, and sustain for, decades. And in that respect, if you pick the right companies, they may have a compressed outcome range. But I would argue, and proof is in the pudding, I've just got started and you're going to ask me again in 10 years. I would argue that if we've done it right, we will have a much, much lower failure rate because we're investing in companies which are a little less sexy and a little less subject to the vagaries of popularity or, viral nature or, mass adoption. Because, if you're selling to a utility or if you're selling to industrial, corporate buyers, it's not as volatile.
It's true. When you start looking at that, though, then you start running into other challenges, right? Of selling to government is,
yes, it is.
It is as bad as university.
Yes, it is. It is. And you got regulatory staff and you got all the rest of it. I mean, that's another thing, you always say to founders, it's a trope. It'll take you 3 times as long to raise the money. It'll take you twice as long to get your first million, etc. It is so much harder to get in the door. But the point is, once you're in the door with a lot of these customers, you're in for the long term at quite high price points. And so, it's the Bill Gates thing, isn't it? Right? You overestimate what you can do in a year, underestimate what you can do in 10. So, all the projections, all the fancy, here's our growth. We're going to be, triple, double, double, whatever, we'll be $100 million company. You kind of discount all of that because this is not really how it's going to happen. But once you are in there and you have proven it and it is effective, then you've got really long-term locked-in customers. So there's an example about an agriculture company we invested in, we really love, called Verdi. It does precision irrigation and fertigation for farmers. So it waters plants at the plant level. Its stated goal is to save water. That's its actual impact. They want to save 30 billion liters of water a year, in American agriculture by 2030. In their first pilot year, they did 7 million, so they're on their way. But here's the thing. We love the notion of co-benefits and systems change. So something like Verdi puts in its system, it's a small sensor. So we're talking about, hardware light, software business. So a small sensor, all the plants get the appropriate fertilization that they need. And you end up with a higher yield, a better quality crop, and a harvest that happens simultaneously. So instead of having to pay for 2 harvests, you only have to pay for 1. So all those things combine to put more money in the pocket of the farmer. They get a better outcome all around. And that then becomes a self-fulfilling loop, which is typically farmers have not had enough money, subsistence margins, to pay for technology. But suddenly you're giving them something that actually puts more money in their pocket. The technology is affordable. It becomes a sort of win-win-win in all scenarios. And then you get something like the California legislature, putting in laws that say they'll pay farmers to save water. and it becomes a sort of virtual circle of benefit. And they saw their 3 pilot customers more than 5 to 10x the land under management after a year. They already hit $1 million in ARR. Now, maybe they'll never be a $10 billion business, but it's going to be a very successful, very long-standing, successful business with customers, and very, very unlikely for them to churn out, because once the system's in place and they've got 10 years of data, no one's going to leave.
Yeah. No.
So I like a company like that, right? So multiple co-benefits, systems change where you're making a system better at a sort of picks and shovels level without being too ambitious and trying to get the whole world to change. You're doing something better for a particular set of customers that will be very loyal.
If they didn't take into account into their valuation the SBIR grants, because usually once you get one, they'll jump their valuation by 2 or 3x, that it's like, if you guys actually didn't take the valuation jump from that and just considered it free money for being able to kind of get it going and started, the math looks significantly more attractive from that view. So being able to come in, especially at the earlier valuations, and not overpaying, I think is super critical from that kind of viewpoint.
I mean, that's, from our perspective as the investors, you and I have talked about this before. One of the big issues, of course, is that founders assume that if you're trying to tell them to keep their valuations low, that you're somehow trying to screw them, which of course is a terrible misunderstanding of the system, because how many companies have you seen that raised a lot of money in 20 or 21 or 22 at these wonderfully exalted, and they're now having to do these down rounds, which is so painful for the founder. And it's not as if they are foolish people. It's just that when someone says, let me give you more money and dilute you less, how can anyone resist that? And what they don't realize is that later on, it's going to come back to bite them in the ass.
I mean, I think that was the toughest part of 20 and 21, is that I'm looking at, you'd have those conversations with founders, just like, guys, you're not worth 15. You're just not.
It's really tough. I remember, I was an operator before being a VC, and I remember, once sort of having a conversation with someone about the notion that you are the most valuable from an ROI perspective on your own stake when you have an idea on a piece of paper, because someone's valuing you for absolutely nothing. And then once you actually have to build something and get it out in the world, there's actually a pretty long period, maybe it's 7 years or 10 years before you grow into the valuation multiple that you had at the point where you started. Yeah. And so if you make that journey too hard for yourself, you're going to burn out, it's going to be miserable, and you're going to lose all your key employees, because then, their stock's not going to be worth anything. So I always say that the wisest approach a founder can take is to raise more than they think they need, worry a little less about dilution and their total ownership, because it's much better to have a smaller piece of a much bigger pie. Make sure they assume everything will take longer than they think it's going to, and hope for a better outcome, and don't overvalue yourself too early.
100%. I keep telling you, a point or two now is not going to matter at the end.
It's really not going to matter.
It's get there.
Generosity is the wrong word, because you're not generous towards your VCs. But if you actually trust them and think that they are your allies along the journey and have good advice and can help you in a bind, then the sort of generosity of mind is to say, give your employees the right amount, motivate people, share the spoils, as it were, and under promise and over deliver, essentially.
Yeah. That was rule number 1 in sales for doing commitments.
There you go.
All right. So one, I guess my big kind of other question that I have is that nuclear is become, again, 20 years ago. So I went to Santa Cruz for undergrad for environmental science. And I remember writing a paper then, like, nuclear is the only thing that's going to save us right now, unless battery technology makes a huge jump. It's now back in the news because we have such a need for it with generative AI that I think it's a little crazy that they turned 3 Mile Island back on, but there's not really the publicity that you want in general. But what's your stance on it? How are you feeling about that as a potential clean renewable source? And what have you kind of seen in the market in general?
Okay, so a little context. I actually worked in a nuclear facility.
Oh, even better.
Yeah. I even actually once accidentally set off the alarms in a nuclear facility and got the whole place vacated.
Oh, that would be the most terrifying thing.
I did not admit it was me. I pretended it wasn't me. I said, why are we being evacuated? What's going on? And I knew exactly that it was me, and I was always too embarrassed to ever tell anyone.
Oh my God. Well, welcome to the hot take for the show.
There you go. So the two things that I remember at the time was talking a lot to people who live locally, for whom this nuclear facility was their, bread and butter, their community. And they said, we know there are risks, but we don't think there are any more risks than any other, dangerous industries. And this is our livelihood and our community, and we would really rather this place was not, shut down. And I remember thinking at the time, it's that sort of notion about how we assess risk. Risk is not mathematically calculated, it's emotionally calculated. You're more afraid if you think the risk is higher if you think the outcome is scarier. People are more afraid of a shark attack than they are of a car crash. But statistically, right. So the point is, risk is to do with the outcome, not the inputs, essentially. One's assessment of risk. And I think that's why nuclear, was very cold for a long time. Now I think people are beginning to realize that we've lost 20 or 30 years of development in the nuclear space. We might have been in a better position if we'd not, given up on it. We as a firm are too small right now. Inshallah, ask me again in 10 years, but we're too small right now to be investing in like nuclear power generation facilities. However, we are interested in what I call nuclear adjacent. So for example, you can't test out outcomes in nuclear in the real world. You actually have to simulate them. So if you want to go into the space of how do you build an efficient nuclear plant, you're going to have to do most of that simulation with software. That's interesting to us because that's somewhere where we can be involved in nuclear, learn about the industry, figure out where what I call the adjacent businesses are going to succeed, who needs what, without actually having to go into the business of, building nuclear facilities.
I think it's a great point and a great place to be able to play, especially with, coming back. You're right, 20 or 30 years of development lost, but I think it's one of the only kind of tools that we have, right? It's the main tool that I see kind of right now that we have to be able to shut off other things that can quick and slow down the process of us hitting that couple degrees shift. So
there's actually one other point about that, which is that, the assumption I think some people make would say, if you're in climate, that must mean you're against fossil fuels, and the truth of the matter is that there is this, what I call, the transition period. It's like there is a period where it's probably behooves us to help make anything around the fossil fuel industry more efficient, less carbon intensive, do things better around that, because it's not going away straight away. It would be wonderful if we could wave a magic wand and it suddenly transitioned overnight, but that's not the case. So there's also, interesting plays in how to make that industry cleaner or dirty industries cleaner in the short term.
I see cars especially as one of the big challenges from that perspective. If you could figure out a way to do carbon capture and turn it back into reusable fuel that way, and then everyone wouldn't have to change habits, then all of a sudden you have that's the shift.
Yeah, but the problem I think with carbon capture, and I'm again no expert on that particular, climate's so huge a space. Pick your vertical and you could spend your entire life in one vertical. So I'm no expert on carbon capture, but sort of my understanding is that the amount of energy required to do the capture so outweighs the amount that you capture that it's still so inefficient that I wonder if there are better arenas to be playing in.
I don't disagree, but if you start looking at nuclear and God willing, if fusion ever ends up happening, right, that all of a sudden especially from a nuclear standpoint, that if the energy is cleaner in technicality, that then because at this point, I feel like we're so far gone that we are going to literally need every tool in the tool belt to be able to stave this off. California's been on fire continuously for as long as I can remember. So, yeah.
and so then you start asking the questions about, the regulatory environment and how does government decide that it's, now is the time, and how do you find ways to incentivize and motivate all the changes that are required? It only comes from regulation. You can't incentivize big corporates to change their behavior unless there's a profit incentive for them.
Yeah, I was about to say the insurance companies have shifted a lot on their stance from where they were before on kind of being 100% against it. And then over the last 2 years, it's been a huge kind of shift from their perspective, because the risk has gotten so much heavier in general that they're leaving markets entirely, but it's a huge part of their risk models now for looking at it.
Well, one of the things I think is interesting about that is when you say they leave markets entirely, I think insurance companies are kind of like the canary in the coal mine. They're the bellwether of what's going to happen 5 to 10 years out. So when you see them refusing to write policies in certain areas, you start realizing it's going to be unlivable in those areas except for the very wealthy, because if you can't afford insurance, you can't live in a place that's, there's probably going to be a demographic shift in the middle, right? Away from the coasts, away from certain parts of. So if you start thinking about those long-term demographic shifts, then there's also opportunity as an investor around what's going to facilitate those shifts, what's going to be important when you resettle more people in other places. And to me, one of the most important things to be paying attention to is, the resilience of the electrical grid, because obviously without that, we're kind of screwed. And so anything that helps with load shifting, power management, reduction in power usage, those are all really critical, what I call small effects, like, lots of little things everywhere all at once. You can do several things in your home. You can do several things at a corporate level. And there isn't going to be one solution for everybody, right? Because in some places you'll need geothermal, and other places a heat pump works, but solar doesn't. And another, solar's fantastic, but it's all necessary. And that's why I think there's room for thousands of companies in this space.
Gabby, I absolutely agree. And honestly, it was a great conversation. Thank you so much for coming on the show. Really appreciate it. And welcome back anytime to be able to dive through this.
Really a pleasure chatting with you, always.